The business cycle refers to the recurring pattern of expansion and contraction in economic activity that occurs over time. It is a natural and unavoidable feature of modern economies, and understanding its dynamics is crucial for businesses, policymakers, and individuals alike. The business cycle typically consists of four main phases: expansion, peak, contraction, and trough. During an expansion phase, the economy is growing, and output, employment, and consumer spending are all on the rise. This is often accompanied by low unemployment rates and increasing business investment. As the economy reaches its peak, growth rates start to slow down, and the upward trend begins to plateau. After the peak comes the contraction phase, during which economic activity begins to decline. Unemployment rates rise, consumer spending slows down, and businesses start to scale back on their investments. This leads to a period of economic downturn, often referred to as a recession. The trough marks the lowest point of the cycle, after which the economy begins to recover, and the cycle starts anew. There are various factors that can influence the business cycle, including changes in consumer demand, shifts in government policy, and international events such as wars or natural disasters. Monetary and fiscal policies can also play a significant role in either dampening or exacerbating the effects of the business cycle. For businesses, understanding the business cycle is crucial for strategic planning and decision-making. During periods of expansion, for example, companies may consider expanding their operations, investing in new technologies, or hiring more employees. Conversely, during periods of contraction, it may be necessary to tighten budgets, reevaluate expansion plans, or explore new market opportunities. Policymakers often use monetary and fiscal policies to manage the business cycle and mitigate its negative effects. For example, during a recession, the government may implement stimulus measures to boost consumer spending and business investment. Central banks may also adjust interest rates to influence borrowing and spending behaviors. For individuals, the business cycle can have a significant impact on employment prospects, income levels, and overall financial stability. During times of economic expansion, job opportunities tend to be more abundant and wage growth is more likely. Conversely, during a contraction, job markets may tighten and income growth may stagnate. In conclusion, the business cycle is a fundamental aspect of modern economies, and its impacts are far-reaching. By understanding its dynamics and how it can influence economic activity, businesses, policymakers, and individuals can better prepare for the inevitable changes and challenges that come with each phase of the cycle.